Welcome, everybody. Great to have you guys back with us for a new webinar. Today's topic, what is limited pay whole life insurance? With me is Barry Brooksby, my partner here at Insurance and Estates in all things whole life, strategic whole life, infinite banking, and a lot of other strategies that by other names that go along with that. So Barry, welcome.
Thank you.
Our goal is to help you guys understand your options when it comes to whole life insurance companies and policies. And with that, an important aspect of this is limited pay whole life. So it might be a term that even if you started into looking at whole life insurance and strategic whole life, maybe you haven't heard of the term limited pay. And we also want to talk about the different options available for designing a limited pay whole life policy and the drawbacks or a few drawbacks of limited pay whole life. And finally, we'll talk about a few of our top companies, best companies for limited pay whole life insurance and why perhaps we've chosen these companies, just to give you a little insight. We're not going to go too deep with that, but we'll give you a little insight into that. So again, let's kick it off. Barry, do you want to offer the definition of limited pay whole life?
Sure thing. It's a whole life policy that has a set period in which you pay a premium into the policy, either for a number of years or to a specific age. And the question comes, well, why would I want this? One of the things with whole life insurance that people believe is if I lock into a whole life policy, I have to pay a premium my whole life. And that isn't necessarily true. Even in a traditional whole life policy, you can stop premiums. But some people say right out of the gate, I only want to pay policy premiums for 10 years, 15 years, 20 years, or maybe to the age of 65 when I'm going to retire. So we set the policy up specifically for that time frame, and then the client is done funding, but the policy doesn't go away. The death benefit is still there, but they're no longer funding premiums, and it allows them to be done funding the policy.
Cool. So it's basically paid up at that point. Is that a good way to put it?
That's correct.
Barry, in your experience, is there a most common time period for people to pay for do limited pay, or is it all over the board, or what are your thoughts on that?
Yeah, it is all over the board. If someone is wanting to have cash value in the policy that is tax deferred or tax free, they would need to fund a policy at least 7 years. There's a MET guideline there. But I've seen 10-year paid up policies, 15-year, 20-year, and then something we'll maybe talk about later, even a single pay policy where a person would only put in one premium payment, never make another premium payment again. That's a single pay policy and they're done.
And if you guys hear the term 10 pay or 20 pay, Barry, typically we're talking about a limited pay under those kind of references.
That is right.
So a lot of flexibility, set period of years, and then the policy's paid up. And one thing I wonder if we should address before we jump to the next slide is just with whole life, when it's paid up, I mean, it's really paid up. You're not going to have any increasing costs or any issues that can deplete the policy down the road, correct?
Yeah, as comparison, if you have a 20-year term insurance policy and you fund that policy for 20 years and you're still living at the end of 20 years, the policy is going to lapse. You're done with the policy. Now, you could pay a lot higher premiums to keep it going, but generally speaking, they're too expensive. The 20-year time frame is done. And there's no life insurance after that if you have a term policy, whereas if you had a 20 pay whole life, there will be a higher premium that you would have put into the policy, but at the end of the 20 years, you don't lose death benefit. It's a permanent policy that really will stay with you until you pass away. It doesn't matter if you pass away at 60, 80, or 100. It is a permanent policy that will always be with you.
Let's think about maybe some of the more strategic advantages of limited pay. Barry, you touched on it. No more premiums after you get through the payment period, whatever it is, 7 years, 10 years, 20 years. A couple of the other advantages that I know you'll want to talk about, I'll just highlight them, is, got some long-term care advantages with these kinds of policies, which is pretty exciting in today's climate of increasing long-term care costs and the idea of aging. And the other aspects, high cash value. We talk a lot here at Insurance and Estates in cooperation with Barry and his expertise. We talk a lot about high cash value life insurance and the idea of a personal bank strategy. The other thing is the rate of return. Barry, you probably want to speak to that. If limited pay policies, can they get a better rate of return long term because you're sort of capping the premiums? And of course, life insurance for children and help, kind of planning for kids might be a great way to do limited pay because they'd have a fairly long period. They could do 10 or 20 years on that policy. So how about those advantages, Barry? Any experience you want to interject in any of these areas?
Yeah, several. And speaking of kids, imagine if your parents would have done this for you, had a policy paid up in 20 years, they give it to you as a gift, and you have all this cash value to use throughout your life. That's a great advantage and a wonderful gift that a parent could leave to a child. As far as high cash value and an increased rate of return, with a whole life policy, it is an asset. And a person is growing cash value inside that policy, and the cash value is liquid. So they can use it for real estate investments or to invest in their business or to go out and buy a car or go on vacation if they want to. And yes, with the limited pay, you can see an increased rate of return as we compare it to a traditional whole life. What we always try to do, doesn't work every time for limited pay, but what we try to do is add a paid up additions rider that would increase that rate of return even higher. If someone comes to me and says, my focus is death benefit, well, by all means, that's what we want to provide for the client. Give them the best, least expensive death benefit possible in a limited pay whole life policy. But if they come to me and say, I do want limited pay, but I'm looking for the greatest cash value growth, then we increase the rate of return even further with a paid up additions rider.
And that's really a key point. I'm glad you brought it up, Barry. And so anybody listening, there's a big difference between a prototypical whole life policy that's focused on death benefit and what we call a high cash value policy that's really more geared toward expediting cash value growth, creating a personal bank, doing infinite banking, these kind of things. So two kind of different strategies. Neither is better than the other. It just depends on your goals, correct?
Yep, correct.
All right, so drawbacks. Obviously, a limited pay whole life policy wouldn't be as cheap as, say, a term policy, something like that, Barry?
Yes. Now, here's a myth. The myth is whole life insurance is very expensive. Well, what isn't necessarily true about that myth is if you insured your entire life with term insurance only, let's say you had a 30-year term policy, and at the end of the 30 years, you renewed and got another 10 or 20 or 30-year term policy, and you did that throughout your life, you would pay more in premiums for those term policies than if you would have started off with a whole life policy initially. Why? Because every time you renew, you're older, those premiums in the term policy are higher. Whereas if you start a whole life policy or a limited pay policy in your 20s or 30s or 40s, it's locking in your age. It's locking in your cost for that death benefit amount. There's no increasing costs. There's no renewal. Even if your health declines, those premiums don't change. So when you say it's not the cheapest life insurance, what we want to emphasize is the premiums will be higher because you're cramming more time into a shorter period. In other words, the example I like to use, Steve, is a 15-year mortgage versus a 30-year mortgage. Which one of those is going to have a higher monthly payment going back to the mortgage?
That 15-year.
Yeah. Why? Because again, you're cramming more time into a shorter period. And because of that, you're paying off the home in 15 years and not 30. That same principle applies to limited pay. If you look at your lifetime, if you're going to live to 90 and you're 30 or 40 today, that's 60 years that you still have yet to live. But if you're saying, I want to plan on a life insurance policy to the age of 90, but I'm going to pay all the premiums over a 10-year time frame, that's why the premiums are higher.
The only thing I'll throw in on that is just that their term life is the companies, in my estimation are probably banking on not paying a death benefit oftentimes.
That is true. Less than 2% of term insurance policies pay a death benefit. Now, I own term insurance, but I also own multiple whole life policies. I'm married with 5 kids. I want greater death benefit while my kids are in the house and going through school, etc. So I do protect my overall human life value with more death benefit on the term side. But once my term policies do expire, my whole life policies death benefits have continued to grow. So over time, the hope is that the whole life is going to give you enough death benefit to replace the term. If not, you also have the cash value growth in there that you can use. The other thing you have here is MET concerns.
Right.
That is a modified endowment contract, which means if you MEC a policy, you can lose the tax deferred or tax-free benefits of the cash value. The death benefit's always tax-free. The MEC issue is really geared toward the cash value and the use of the cash value. So if a client is young and we do say a 10 pay, there is a possible MEC. We would just want to design the policy not to become a MEC. The one thing that you can't get away from in a MEC policy is if you do a single pay. If a client comes in with brand new cash, they do a single pay policy, that policy will be a MEC every time. The only exception to that is if they have an old permanent policy with cash value that isn't a MEC, and we do what's called a 1035 exchange, and we roll that cash value into a new policy, a better policy, with a single pay, that instance is not a MEC.
I like it when you get deep into these strategies, Barry, and as you're demonstrating, I mean, these are very sophisticated strategies. Not everyone can do it, and not every agent, I should say, out there that's selling life insurance would have a concept of this. I think I'm confident in saying. So you got to know what you're doing. And the other thing is single pay would be a type of limited pay. I just wanted to clarify that for people. It would just be making one payment versus payments over 10 years or so, or whatever the number is, correct?
That's right.
Limited pay whole life. A lot of our whole life webinars talk about certain criteria that people look at or should look at and that we look at for identifying top companies. And these are just some general parameters that we use. The one that might catch your attention, the non-captive, we like to work with companies and shop companies. So that's important. There are a number of fairly solid companies out there that are captive, and just means that they have agents that only sell their products. Whereas we like to work with non-captive and be able to bring the best companies to our clients. And the other thing is mutual companies. Barry, you want to talk about that a little bit?
I will quickly. The mutual companies are owned by policyholders, and they invest more conservatively, and they also pay a dividend. When they pay that annual dividend, it comes back to us as policyholders. We only write these policies with mutual companies. They're safer, they invest conservatively, and frankly, I want to earn the profit, and I want my clients to earn the profit in the form of a dividend coming back on an annual basis into the policy's cash value.
Good stuff. So dividend paying mutual companies, well-rated, non-captive, and then you already talked about paid up additions. And these are other general whole life policy benefits. You got guarantees, you have fixed premiums. When we talk about our criteria and top companies, MassMutual is one we like to talk about. And you put this together, it looks like we've got sample rates. Example, I'm going to stress that, of a limited pay case that you put together.
That's correct. This is a 20 pay policy on a 40-year-old for $500,000 a death benefit. The premium is $11,405 a year. And there's several things I like to point out. One is that, yes, a $500,000 death benefit is being purchased, but as a dividend is paid every year and reinvested back into the cash value, there is a growing death benefit. So at the end of the 20-year time frame, assuming dividends are still paid, which MassMutual has paid for over 100 years, the death benefit at the end of the 20-year time frame is $720,000. But all they paid for was the $500,000. You also notice that the cash value total cash value at the end of the 20-year time frame is $309,000. So this person at the age of 60 has several options that perhaps they wouldn't have had if they didn't have this policy in place. They can use this cash value for income, they could use it to go make purchases, and they have a $720,000 death benefit that allows them to actually spend and enjoy more of their money or leave a larger legacy.
Barry, would you be defining this as more of a high cash value strategy, this particular example?
Actually, Steve, no. This is a traditional 20-pay design where if we wanted to see even greater cash value, we could. But we're kind of under-promising and over-delivering with this because it's a conservative model. It's a very traditional 20-pay whole life policy. So it is possible for this person to have even greater cash value than we're showing. But as a 20-pay sits, remember, he's done funding. Starting year 21, there's no more premium going into the policy, but watch what happens. That cash value is still growing and the death benefit is still growing. It's a really great way to go for someone that says, I want to be done. There comes a point in my life I want to be done. And even when they're done, they're still getting growth on both the cash value and the death benefit.
That's exciting. So there's no MEC, modified endowment contract risk or anything with this kind of a design.
That's correct.
Cool.
And in this example, Steve, this is a female, 50 years old, on a 15-pay for $1 million death benefit. You see the death benefit here. It is growing a little bit over time. At the end of that 15-year time frame, after 65, you see the death benefit 1.2 million, cash value of 618,000, total premium 34,000 a year. And you think about what has gone into this policy, 34,240 times 15, so 513,000 with a death benefit of 1.2 million. And starting year 16, again, the zeros, no more premium going in, but you see the cash value continuing to grow and the death benefit also continuing to grow. Steve, another preferred company we use is Penn Mutual. In this illustration example, this is a single pay policy, meaning the person is putting in $100,000 in year one and not making an additional second or third or fourth year premium payment. So we see the 100,000 go in year one, but year two and beyond, you see all these zeros, which are showing there is no more premium going in. What's pretty remarkable about this is this person immediately has 94,000 available of the 100,000 they put in. Now, this is on a 40-year-old healthy male, and we see that the death benefit they get is 482,000. So what that means is if they did pass away this very first year, they put in the 100,000, the life insurance company Penn Mutual would pay out a $482,000 death benefit. By the time they hit about 2.5 years, they're made whole on their cash value. It's about that 2.5 year point where the 100,000 in cash value is available. And then starting year 3, you begin to see the cash value growing by more than the 100,000 that was put in. And then obviously the death benefit is growing over here as well. So I run this out to say the age of 65 in retirement, he would have turned 100,000 into 360,000, potentially tax-free, with a $748,000 death benefit. The one caveat to a single pay, as I mentioned earlier in the webinar, is this cash value is tax deferred. So any gains above the 100,000 would be taxable.
Gotcha. Similar to another typical investment. So you still got all the advantages, you just have some taxes above the 100.
That's right. And what's remarkable about this plan, when we talked about internal rate of return on one of the earlier slides, this
beat me to it. I was going to ask you about that, but The
Yeah,
IRR.
this policy has an IRR of 5.3%.
There
So
you
if you
go.
compare that to like a CD or another type of investment, that's a pretty good return for someone that's going to put in a lump sum and not think about it ever again.
That's every year, right, Barry?
As if they earn 5.3% every year. That is correct.
Which is remarkable when you look at it that way. Where else can you get that?
Yep, that's right.
In light of those examples, Barry, which were fantastic, you can see the predictability, the cash value grows with these limited pay policies and how they can create liquid cash resources that could be leveraged over time. I think this is a great way to wrap up conversation regarding limited pay whole life. Take the next step. There is going to be a link below. Do a quick questionnaire and schedule a one-to-one conversation with Barry to learn more about how this can impact your finances and your plan, your estate plan, and the advantages. So we're certainly welcoming you to take that next step and do that. We appreciate it.